We've saved the best to last, I assure you. Our speaker for this session is Rob Prue, Senior Managing Director of Lazard Asset Management. Robert is a Senior Executive at Lazard with responsibility for their Asia-Pacific operations. Rob's theme for this session is global investing, moving from volatility to uncertainty. Rob, thank you.
Cheers, Gary. And good morning, ladies and gentlemen. New challenges under uncertainty. I sort of toyed with that word and what do I title it for quite some time. And given the elections, I actually, being from South America originally, I found the whole delay of the independence over 17 days and deciding who they're going to choose quite interesting. See, where I'm from, by day 10, the tanks would have come in and would have been welcomed. But be that as it may, it's obviously quite interesting to be here as part of history. But the uncertainty that I want to refer to in the presentation really relates more obviously to the economy and less so the political, although the political uncertainty certainly is impacted by it and will be impacting us. But look, I'm a firm believer, I love history. And if you do love history as well, there's this great book, it's called What If? And what they've done is, in this book, it's 8 authors. It has 8 historians, and they're basically given 7 different stories. And they are asked, what would the world look like if different things happened? These 8 very well-recognized historians. One of the things they ask is, what would the world have been if Hitler hadn't invaded Eastern Europe, but actually went south to the Middle East? And it's actually a fascinating story, so if you are a lover of history and you're looking for something to read in the nighttime, I highly recommend this book. But let me turn this a little bit to our field. And let's actually suggest, well, what if Paul Keating was Japanese? And what if he was the Minister of the Economy back in Japan in 1991 when, of course, Australia introduced the superannuation levy? And it's, the hypothetical questions I want to leave us historians is first, would the Japanese superannuation industry have grown like the Australian? Now, yes, of course, there's demographic situations and nuances, but again, we should ask ourselves that. Secondly, would the Japanese super deal be a defined contribution, as it is here, or as it is in Japan, 99% still DB? And probably the most pertinent question for us today is, would we be having this conference at the Railway Hotel in Fountain Lakes, or would we be having it here? Because let's face it, superannuation is very important, but is it necessarily any more important for the population than something like healthcare and health insurance? They're both vitally important, obviously, for our benefits post-retirement. But again, I think what I want to discuss in this presentation is we have to recognize that at the time when superannuation was introduced, we had something working in our favor. And that's what the markets were extremely helpful in allowing us to build this industry to what it is today. So let's go on further ahead of that, and let's talk into the agenda. First, I want to talk about the markets becoming more unstable. Now, you've seen all these stats about the increased volatility. You've seen the markets yourselves going up and down like a fiddler's elbow each day. But this is simultaneously happening when people's risk appetites are shrinking. The markets are becoming more volatile and more members are becoming concerned. The third point is, what defines risk-free? What is risk-free? Is it relative to what we need to retire on? Is it a sovereign debt? Is it cash? And lastly, truth or consequence. And this is probably going to be perhaps a little bit controversial, and I want it to be so, I want it to be fun. And that's managing super under this regime of uncertainty. But to consider all these things, let's continue on, is the migrating from the old regime to the new regime of uncertainty. So let me actually preface it by saying, what does that mean? Now, Keith Ambekshire and Peter Bernstein simultaneously came up with this thesis that at the end of the day, what really matters is inflation or inflation cycles. Inflation cycles has a much more detrimental and noticeable impact in the real cost of capital. And if the real cost of capital, of course, is the value of money, let's study these. So what I have here, sorry, it doesn't quite show, but I'll just go through the numbers. But basically, we have 4 inflationary regimes. 1930s, deflation. 1950s, benign inflation. 1970s, rising inflation. And of course, late 1980s, 1990s, disinflation. We're still positive inflation, just each year a little bit less so. What I want to highlight here with these numbers is that the markets we've just experienced have been extremely robust. The best 36-month period in the 1990s for equity returns was 107 nominal. The worst, only negative 3.1. Under benign inflation, again, a period where inflation is no longer a tax on real assets, the figures are very similar, 137 versus negative 3.8. Now, introduce uncertainty in rising inflation and deflation. Obviously, very vastly different consequences. The similarities on equities are quite disturbing. In the case of equities, plus 165 for deflation, minus 76 for deflation, and for rising inflation of 1970s, plus 45 versus minus 45. Now compare that to the period we've just come out of disinflation, where it was 100% versus minus 3%. The way you made money basically was you dialed up the risk budget. Leaving asset class at 70-30 was okay because although we had corrections, the trend was upwards. So you can see that the vast difference there between the good periods of inflation no longer be seen as a threat or detriment on real assets versus, of course, the periods of uncertainty. So now what we've got is this is the distribution curve of equity market returns under these same regimes of benign and disinflation. You'll notice that the curve is somewhat relatively normally distributed, identifiable. Introduce deflation and rising inflation, this curve becomes fat and flat, meaning that if you have a static asset allocation, only thing you're going to see is increased volatility. It becomes much harder to immunize your assets under this regime of uncertainty. So let's continue on with this regime of uncertainty and what it means. Now, perhaps this is somewhat exaggerated, but this is an actual risk and return for equities, bonds, and cash for the period of disinflation, the 1990s. Obviously, very positively skewed. We as investors were compensated for taking each additional unit of risk. Now let's introduce uncertainty. That's no longer the case. Under deflation and under rising inflation, vastly different consequences. The similarities are striking. We are no longer compensated for taking each additional unit of risk. Now, you could argue, oh, come on, Rob, 1930s, that will never happen again. Let's have something a little bit more modern. Fine. Let's look at Japan. Same thing. In 1990, as I said before, the Japanese Nikkei index was around 37,000. Now it's well under 10,000. So whilst you and I may be comforted to say in the long term equity markets go up by 7%, the Japanese say something similar. But in the long term, they say equities goes down by 7%. You're not compensated for taking each additional unit of risk. So what does this mean? Should we never take any more risks? And by the way, I would agree with Rob. I don't know whether we are going to inflation or deflation. The arguments mounted on both sides are compelling. And now you add on top of that, you have two schools of thoughts. You have the Keynesians and the Austrians about what is the correct way to manage ourselves out of this. But my point is, even if you can assign a 10% probability of occurring, it would be naive not to at least assess the impact on your portfolio. So whereas I am cautiously optimistic, if someone were to tell me that there's a 10% chance that you're going to get run over today, I'm going to look both ways. So we've grown up. Risk isn't what it used to be. Before we go a little bit further, let's discuss about the pensions, because this is actually quite important as we go forward, specifically as it relates to legislation. PAYG or Social Security, that's legislated. Government says what it is. By the time you turn 65, this is the benefit you get. Problem is, it's legislated. Okay, governments can vote that in and change the rules. We've just seen a modest change from 65 to 67. We can also see further changes as far as what's taxable and what isn't taxable. My point is, whatever you think Social Security is today, in 20 years' time, I can guarantee you it's going to be utterly different. What constitutes your eligibility for Social Security? Because it will be the changes will be legislated just as it was brought in. Secondly, defined benefit. Now, defined benefit is a binding contract between two parties. In this case, the employer and employee, or if you like, the union movement and management. And so for it going forward, the only way you can change this is perhaps stop offering it. Or for those defined benefit contracts that still exist, is negotiate with the unions and say, okay, well, we're going to go broke. We can't necessarily afford both. We can't do it. And find some sort of commonality. By the way, if you want another really good book, While America Ages, by Lowenstein. Fantastic book. It gives a good history of the defined benefit movement in the U.S. And lastly, defined contribution, allocated savings. Now, I call it allocated savings because at the end of the day, it is that 10% or 12% or 15% goes to save while you retire. Now, let me be a little bit controversial here, please. Is it ethical? Is it the right thing? Because we're offering individual members caveat emptor. Here it is, here you go. You are now responsible for financing your retirement needs. For the financially naive, is that necessarily fair and reasonable in this world that we live in? Let me continue that train of thought. Is it necessarily what they want? So Sue mentioned yesterday, and I'll discuss that in a minute, about what some of the members are looking for, and that's quite important. The last bit is eschatology, if you like, the study of the end. Now here, of course, we have two pictures, which states the bleeding obvious that we're all aging. Keith Richards, he's turning 67 in December. The mere fact that he hit 67 is an accolade on medicines today. But Barbie's turning 52. So again, we're all obviously turning quite age. And the other thing I mentioned before about healthcare, this is also very important because healthcare, we all want to manage CPI plus, right? That's what we want to manage towards. Healthcare CPI is nearly double of regular CPI. Did you know that a study in the US has recently showed that Medicare spending, US Medicare spending, 30% of a person's lifetime medical spending from cradle to grave, 30% is spent in the last year? That's an amazing stat. That blows me away. In many ways, medical advances has improved some of the things that we do. Case in point, Lipitor. I use Lipitor. And it's created benefit from heart disease. There's been a huge reduction in heart disease. However, Lipitor doesn't change the fact that I'm still eating McDonald's. My point is, diabetes too is on the rise, a crippler, also very expensive to look after. But let's keep on going. About the demographics, before I mentioned obviously about healthcare CPI, but let's introduce something else, demographic CPI. Now back in 1940, the US under FDR, New Deal program, introduced Social Security. It's actually not the first country. Bismarck in Germany, of course, introduced it in the 1880s. Never mind that for getting Social Security back in Germany in the 1880s, you had to be 75. And never mind, of course, that life expectancy was only to 55. But my point is, if you think about Social Security, it was a longevity insurance. It wasn't necessarily a right. It was if you happen to age and you can no longer work, the government will look after you. The society will look after you. That's what it was for. Okay, and it's important to understand this because the war veterans were probably the first in human history to be able to afford to retire and that, instead of work till you die. If you think of the farming agrarian societies of the 1800s or the 1700s, they worked until they died. They had to. But my point here is clearly, obviously, that the inflation situation has changed quite significantly, and you've seen these statistics, nothing literally to. But here's a lovely picture of Ms. Ida Mae Fuller. Ida Mae Fuller was the first American female to be eligible for Social Security. She received it at 65 in 1940. She passed in 1975, 100 years old. So life expectancy when Social Security was introduced in 1945 for females was just over 65, yet she lived to be 100. One of the first beneficiaries, for those of you who bother to read that book I just recommended, While America Ages, will also hear another accolade of one of the GM employees. There was a GM employee, a young Italian-American man. He retired. He lived to 111. He was on retirement income longer than he actually worked. So let's continue. Will I have enough to retire on? This is something that's quite pertinent. And please keep in mind, they're very rough rules and numbers here. This is not actuarial driven, but it will help me convey a point. So it's not an actuary here, so those actuaries out there, please relax. I want to convey a point. The first point is, let's have some assumptions. Firstly is that on retiring, someone has $500,000 and husband and wife, and this is, I used to earn $80,000, but I'll live on half that. I want $40,000. And if you look in actual many superannuation books, they say in the long term you should expect your assets in the balanced fund to go up by 7% with CPI of 2.5%. So having these assumptions, you can sort of very easily, with a little envelope, work out how much the drawdown will be. Under normal assumptions, it's a 20-year drawdown. But what happens if in year one that person invests in a balanced fund and the markets get hit with another global financial crisis? Possible. Perhaps not likely, but possible. What happens then? The drawdown falls by 5 years in year one. Now let's assume the worst case scenario, as I'll discuss in a minute. Remember I showed you that under the regimes of uncertainty, markets go sideways. We're not compensated for taking additional units of risk. It goes up and down, don't get me wrong, the markets rise vastly, rapidly up, and they correct in a very W-like manner, but the long term is still sideways. What happens then? If we go into that regime after it falling 15%, they lose another 5 years. So their drawdown has gone down from 20 years to just 10. That is something that scares the average mom and dad. And that's what I was saying before. Is it necessarily something that they want? I understand the logistics. Trust me, I also read the World Bank 3 pillars. I get it. But does that necessarily equate with something that people want? So redefining risk. I actually like this because we've done a lot of talking about risk and we've done a lot of talking about standard deviations and volatility. In fact, there was a few questions about performance-based fees versus risk-adjusted performance-based fees, and more recently when Rob spoke. But what is risk? And the real simple way to look at it is to question and challenge risk. In 2006, risk on equity market volatility was around 6% versus 27% in 2009. Now you tell me when the market was more risky. Was it more risky in 2006 or more risky in 2009? So again, standard deviation is a volatility measure, just rear view, here's what the volatility has done, snapshot, here it is. And yet we live on this definition of risk. Is that the right way to define risk? Other ways we look at obviously is the inflation risk. I'll quickly go through this. To me, inflation risk is a mismatch because healthcare inflation is by far larger than, of course, consumer. And for retiree, this is extremely important based on those numbers I gave you before of Medicare. Asset risk, well, what is asset risk? Because frankly, asset risk can also be redefined. Case in point, some liquid assets are deemed lower risk because they have lower pricing structure. Is that risk necessarily true? Some assets are engineered, swaps. Are we necessarily looking at, so we're looking at, let's say, an inflation index bond. It's very hard to buy them, so some super funds are doing swaps. Oh, well, and they're using the same inflation risk, the same asset risk as though it was a government bond. But when you're running a swap, you have counterparty risks. Is that necessarily being incorporated? Investment risk, Well, sovereign risk. I know we all know about the usual stories of Greece, will Greece go defunct or not, et cetera, but let me give you an interesting stats. Japanese government bonds. They're lower rated than Sony, and have been for a long time. Sony corporate debt is higher rated than JGB's. Now that's, again, very counter to what we're used to in Economics 101 about the taxing powers and their ability to pay themselves out of debt. Sony doesn't necessarily have that. Rating risk. Well, on the rating risk, again, we know that can be manipulated through financial engineering, as the CDS clearly showed us. But to me, the most important one here is the regulatory risk. And I think this is really important because if you think the government, I've always said, don't worry about Cooper 1. Cooper 1 means nothing. It's the market recovered and people will forget about it. And I agree with what some people have said. Cooper 1 will be implemented more by funds than by government. Funds themselves will probably take a more proactive steps in Cooper than the government will in enhancing and enforcing it, my theory. The one we should be concerned ourselves with is Cooper 2, Cooper 3, Cooper 4, because they will continue to happen as the market uncertainty continues. But let me give you this, and that makes a lot of sense, because if you amalgamate superannuation worldwide, globally, it works out to be a $40 trillion to $50 trillion business. That's a huge amount of money. That is now public policy. No government, forget the taxing issue of the situation, no government will let $40 or $50 trillion just move around because some investment banker thinks, hey, this is a great investment tool you should be buying. Ain't gonna happen. But let me give you a quote and see if you can guess who it is. It's a great quote, one of my favorites. The inherent vice of capitalism is the unequal sharing of its blessings. The inherent virtue of socialism is the equal sharing of its miseries. Winston Churchill. In those days, of course, there was a feeling, I guess it had to back in 1930s, the UK was on its knees with the Depression, right or left. There was a feeling to, how do we get over this? Which perhaps doesn't exist, certainly not in the US. So closing question. If demographics are likely to influence contribution levels and member demands, and the regime of uncertainty looks more probable, will we be managing investment portfolios as we had over the last 20 years? Now notice the word probable. Probable is basically implying a 10%, not likelihood, probable. And if it is, then what should we learn by it? Now now I've sort of talked about the doom and gloom. The main point I want to leave you with, if you leave with anything, is the ability to adapt. The human species in the animal kingdom is one of the few species that can adapt to its environment. You put a hippo in Antarctica, it will die. You put a walrus in the Amazon, it will die. The same can't be said about a human. We'll look for food, we'll look for clothing. To prove it in economic sense, how many of you remember 1970s? Remember sitting in the queues for petrol? I do. I was a little kid and I was sitting there with my dad, and my dad would go to the toilet, and it was great because I would take the car for a ride. And then I came back and goes, oh, weren't we closer? No. But then I remember those. We adapted to those moments. How many of you remember late 1980s? 17, 19%, 21% mortgages. Now, say that to someone in Gen Y, they think, what? 20% mortgage rate? They think you're nuts. How many of you remember flying down to Melbourne or Sydney on a military plane because there was a strike? We adapted. The world didn't end. And so the same is true. So as volatile as the economy may be, as onerous as this regime of uncertainty could be, as onerous of rising inflation could be on our assets, we will adapt. The question is, will we adapt en masse? Or will there be a few stragglers out there who will hold back? Or will there be a few pioneers who will actually lead the way? As I always say, some of you have heard this before, the Kennedy crisis. Kennedy once quoted as saying that in Chinese, the two Chinese characters for crisis, one spells danger and the other spells opportunity. But from our presentation, again, this uncertainty is investors will be seeking certainty, and lastly, of course, greater consciousness towards wealth immunization goals. So let's go into the ability to adapt. It's quite important. My own thesis is that static asset allocation of 60-40, 70-30 is dead. We'll look beyond that. Now, we've played around the edges by introducing alternatives, but if you break down alternatives into defensive illiquids and growth illiquids, it hasn't necessarily changed in a significant way. We've played around with liquidity, cash. When cash came, so we held it, but that was more liquidity need than an asset allocation one, I would argue. Resurgence of dynamic and tactical asset allocation. These sound like great fancy words. They were around the 1970s and 80s. TAA was very prominent back then, so was dynamic. And dynamics is just a nice fancy way of saying sell excess profits. And systematic factors, AKA themes and scenarios. And what I mean by that is the China theme wasn't just executed by only buying Chinese securities. Australia, of course, is a huge beneficiary of it. Even stocks like Louis Vuitton was a huge real estate was a huge beneficiary. So these systematic factors are increasingly going to be sought out by investors as they admit that managing assets purely on some sort of 60-40 will be flawed. Case in point, that's how asset allocation was done in the 1970s. We didn't have mean variance optimizers back then, so we had scenarios. Quest for active beta, and this is a really play on word. But my point on the active beta, though, is that people will look beyond the traditional measure of cap weight. Okay, we'll look at equal weight, economic scale, or RAFI, and minimum volatility as alternative sources of beta. So people have been critical of the non-cap weight as having value-like factors, perhaps. I could debate it, but let's take that as, okay, perhaps. Then you would equally have to say that cap weight, as a buy and hold, has a growth factor bias in as much that price momentum is an influence in cap weight. ETFs, hugely growing, where again, people might overweight certain funds that above and beyond where their active manager's already doing it. And then lastly, move from return to return-based portfolio modeling. Downside risk and liquidity needs need to be incorporated into the modeling of portfolio. And this is actually quite important, but I'll touch that in a second. Seeking uncertainty from a certain world. The first one I call widower's dilemma. Sue, again, yesterday mentioned about the needs of members, how they're saying they want some certainty, they want some annuity-like structure. I call that the widower's dilemma. And the widower's dilemma can be executed, that certainty of income, distribution, payment can be executed two ways, one in the DB world and one in the DC world. In the DC world, annuities. Get ready to that word, annuities. You will hear much more of it. You will hear more and more members clamoring from it. Those of you who lived in the UKs know it very well. And those of you who lived in the UK had to basically forget it because in Australia no one wanted it. And so we learned, again, wealth creation, if you like. Whereas in the UK, annuities were very strong. In the US, corporate America can no longer afford defined benefits, so they closed it. If you're over, and so a lot of money has been flowing in DC or 401k, yes. However, if you're over 50, the number one sought after was not 401ks, it was variable annuities. Variable annuities is highly sought after, and basically what that says, it makes it a DB-like certainty. You will receive $40,000 per year until you die or until your wife dies. And people want that. Are they going to be paying more money? Yes, I call that the contango effect. We all pay for home insurance. None of us want to have our house burned, but we're protected. So each year that our house doesn't burn, we're losing money. The same can be said about that contango effect, or what I call the widower's dilemma. In the DB world, portfolio insurance, or LDIs, are becoming very big, very much in vogue in North America. Secondly, deleveraging beta. There's a lot of criticism being directed at some of the illiquids because all they've done, and some of them have been, infrastructure was notorious in the past, some banks in particular, was they grabbed the asset, they levered it, and they charged you off the levered asset. And they gave that asset a bad name. That asset is still a very good name, but just delever it. There's always going to be a level of operational leverage. You can't get around that. Just don't let your manager actually grab that asset, lever it, and then charge you more money for it. That's exactly how they did it back long ago. And lastly, I can't buy groceries off relative returns. We all still live the agent's game of ratings, be it ratings of managers or now ratings of super funds. The world of choice has brought that to us. What I believe is, as the world of uncertainty becomes more and more probable, people will look beyond that and they'll look at what it is, they'll buy unique structures of what they're being delivered. The variable annuity one is one that I think will have a lot of demand, still with a lot of dangers. Someone once asked me, well, how would you counter that risk? Because let's face it, AIG was one of the biggest underwriters in longevity insurance that a lot of people bought. AIG went belly up. What then? There's a lot of ways around that, and the government may take an involvement in how you regulate that. One simple way that I've heard is like licensing taxis. In Australia, we only limit, you have to have certain number of capital to have a taxi license. The same thing could be said with some of these insurance products, perhaps. But either way, the point shouldn't go unlost. Demands of people under the regime of uncertainty, in their willingness and their desires to adapt, will force them down into alternative mechanisms to what we've accustomed ourselves into delivering. So although our growth has been impressive, we should not ever lose sight that had we done so in Japan in 1990, we would not be here, we would not be DC oriented, and we certainly wouldn't be as large as we are today. There would have been an uproar in the streets if the government mandated more money, because the more money you put into the market, the more money you lost, which was your own. And that is why, although I sit back and look at Japan as a Westerner, I says, they only have 20% in equities. You gotta understand where they're coming from. In Japan, they have something called Daiko Henjo. And Daiko Henjo is a nationalization of the DB plans back into the government. GPIF, the world's biggest pension plan, is a beneficiary of Daiko Henjo. Thank you very much.